Welcome to this webinar. We are recording it on Monday, March 16, following the release of our cross-expertise note in the AI of the storm. And I'm here with my colleagues from Natixis CIB Research to explore the implication of AI, this powerful technology that is also becoming one of the most powerful market narratives. Before we start, I'd like to remind you that you can ask your question via the Q&A section of Teams. AI, in a few figures, it is $10 trillion market capitalization added since the launch of ChatGPT. It is also hundreds of billions of dollars in capex. Estimation for 2026 go to $600 billion only for the Magnificent Seven. And it is also between 1% and 2% of the world electricity consumption already, and expected to double through 2013. And it is also one of the most complex and international supply chain in the world, with many strategic and geopolitical dimensions. And the recent tension also reminds us that this technological revolution is happening and is depending on physical resources. So AI promises versus AI limits. We have been asking a few critical questions. Are the macro impacts large enough to justify such massive investments? How sustainable is the current dominance of AI leaders in this global race? And can the real-world infrastructure energy organization keep up with the current pace of AI developments? And first, let's start first with the macroeconomic and financial risks associated with the rapid rise of AI. With our first question, how systemic is the tech sector becoming? So one striking feature of this cycle is how quickly tech has become central both for financial markets and for the global economy. It is particularly true for the US. So my first question is for you, Chris. To what extent would you say the US cycle has been boosted by the tech sector, and does it create vulnerabilities?
Thanks, Evelyn. We have seen business investment that is primarily driven by AI and AI-adjacent spending. By my calculation, CapEx on tech was about 170% of the total, meaning that most other more traditional CapEx categories were down. Now, the tax provisions from the One Big Beautiful Bill should help to broaden out investment in CapEx in 2026, but AI spending should still dominate, and it's hard to see that dynamic changing anytime soon, because the government and the private sector are so aligned. So all else equal, the macroeconomic implications of AI really should present opposite effects depending on the time frame. Over the long run, AI investment should put downward pressure on prices as productivity improves and displace many jobs. But in the short run, inflation is going to be stoked and jobs are going to be created by data center construction. Now, we have seen adoption start to flatten out a little bit across firms of all sizes. So there's no doubt that AI is going to become a very, very prevalent part of almost all sectors eventually, but it is going to take many years for that to play out. But for this year, at least, I think we can expect more of the same, with investment again being led by AI and continuing to help boost growth in the US.
Thank you, Chris. A few will know on equity markets, because this huge concentration on techs is creating equity tail risks. So we've been wondering whether this concentration in equity markets can create vulnerabilities for globally. True that the concentration is very high. The top 10 stocks in the S&P 500 now account for around 40% of the index weights, and in terms of risk, it's even higher, 60% of its risk in 10 stocks. The tech sector also accounts for more than half of the total expected EPS growth for this year. in the S&P 500, and at the global level, it's also a very concentrated market. The tech sector in the MSCI All Index is accounting for 32% of the market cap, not far from the dot-com bubble peak. So concentration is a risk. It naturally points toward an higher sensitivity to idiosyncratic or sector-specific shocks. And also, with such a concentrated market leadership, there is a concern that shocks originating from large techs may spill over into the broader economy via risk-off events or into the broader equity market. In this regard, we have been looking at tail dependence metrics, the probability of occurrence of common tail events between Magnificent Seven and the rest of the US markets, and between US stocks and the rest of the world. And it's somehow reassuring this probability, this tail dependency is not so high and has shifted down post-Liberation Day. So it is somehow a reassuring fact consistent with what we have seen since the beginning of the year. A sign that sector, geographical and style rotation are acting as partial stabilizer in tech shocks. So from an asset allocation perspective, it's still used for a bullish equity views with a strong focus on diversification. So now let's take a deeper look inside the AI ecosystem. Eric, you often pointed out the tight interdependence and the circular flow of business among tech players, with one very specific company, OpenAI, at the center. Could it eventually become a source of instability going forward?
Yeah, I mean, OpenAI is perhaps less visible, than NVIDIA or Microsoft, because it's a private company. But we argue in a paper that it's increasingly becoming, a systemic risk for the ecosystem, and beyond that, the US and global economy. First, in terms of capital links, the company has now raised a total of $170 billion in total, with about $110 billion just 2 weeks ago, for a valuation of $840 billion. So it's pretty massive. Several high-profile US companies are, now a strategic partner of OpenAI, including Microsoft, of course, NVIDIA, but also companies like Amazon, SoftBank, even Disney, with $1 billion in OpenAI. And sometimes, these numbers are very, very large. Amazon put a total of $50 billion last week, so very significant. They are preparing now an IPO, which could happen sometimes at the beginning of next year with a $1 trillion valuation, which will make it even more central, I would say, to the economy. Then from a business perspective, OpenAI has been able to basically build relationship with dozens and dozens of tech companies in the world. And these links, as you suggested, are sometimes worryingly circular in nature. Now, although they may be structured in tranches that vest depending on different business milestone, it's still, in my opinion, inflated demands in the eye of the investor, and creates certainly some relatively unhealthy dependencies within that ecosystem. So an OpenAI failure is not really acceptable. It's not an option anymore for the ecosystem. We're not talking about a niche experiment. We're talking about something that could literally go very wrong and be pretty bad for everyone if it starts going pear-shaped. And on the other side, OpenAI is actually a company that is fundamentally unprofitable. And it will remain unprofitable for the foreseeable future. This year, it has generated $14 billion of revenue and about the same amount in losses. They are saying that by 2030, they will be able to generate roughly $200 billion of revenues, which is pretty impressive growth, about 75% per annum. Even if they execute perfectly, even if they get there, they will not be able to cover the huge cost of compute that they are actually deploying. A back-of-the-envelope calculation, 1 year of top-of-the-range GPU compute is about $16 to $18 billion. So you multiply this by 10, 12, I think 36 is what they want to have, 36 gigawatts of capabilities by the middle of next decade, and you end up basically with huge losses even in 10 years' time.
And in terms of business models, what option do they have to be profitable?
So clearly, their core business model of selling subscription, that's not going to be enough. They are talking about having 220 million customers, paying customers by 2030, which is a reasonable assumption. It's about 8.5% of the total. Right now, a subscription is $20 per month. So we're talking about potentially $50 billion of revenues, knowing that actually there is intense competition out there, from other models. And so it's unclear to me whether they're going to be able to maintain their commercial advantage in these conditions. It's about the same thing with API, API access for developers, which is price per token. Let's say they can generate another $50 billion on top of the subscription based on that. And assuming that there is no competition, which we know there is a lot of competition. Okay, Claude, for example, is taking huge market share in coding and all sorts of things. So, here we get to basically $100 billion potentially, and they were talking about 200. So we are missing 100. Some of that is going to come from advertising, but let's be serious for a second. It's a very tough business. It's a very difficult to actually grab market share. The advertising budgets are not expandable to infinity. They're going to have to take from the big guys out there. And I was reading actually something quite interesting in a study by OpenAI themselves, where they were saying that only 2.1% of all conversation on the ChatGPT platform are about a purchasable product. So if that's the case, there's basically nothing to advertise. Okay, so I don't think it's going to be a great source of revenue for them going forward. Certainly not in the next 2 to 3 years. Agentic AI, I think, is much more serious. I think that could be basically generating hundreds of billions per year, in e-commerce and these kind of applications. That works reasonably well, but there are still a number of bottlenecks with payments. There are bottlenecks with the merchants who fear that they're going to be disintermediated by this technology. I'm not sure that these things are going to happen like Chris was saying. It's going to happen over a number of years, certainly not immediately. And the final thing that they're talking about is outcome-based revenue. The idea here is to be paid basically based on the outcome that you generate for your customers. So if you're a pharmaceutical company and ChatGPT helps you find a new molecule, you receive a royalty, but you have to think about what this means. A molecule in the pharma sector that is really a blockbuster is about $1 billion in sales per year. 5% of royalties would bring $50 million per year. So they have to find a lot of a molecule before this becomes significant. And so, overall, the business model, what I mean is the business model is really fragile. It's not proven. And in the meantime, they have to build this huge compute capacity, and they are taking a lot of risk in the medium term.
Thank you, Eric. And on risks, there is also another very strong team at the moment. Thibaut, one question for you. Should we be concerned about the news flow around the private debt markets?
Yeah, so what we are seeing at the moment over the last 2 weeks is a big move actually of redemptions, actually hitting most of the private debt vehicles. So we have seen it has started actually with Blue Owl, and after that we have seen over the last 2 weeks Blackstone, BlackRock being in a similar positions, Morgan Stanley, but also Cliffwater. So all have actually suffered a big wave of redemptions, or usually reaching actually above the 5% of the total funds, and making sure that a couple of funds have been obliged actually to block the redemptions at 5% or 7%. So when we look at fundamentals there, what we see obviously has been the case for a couple of quarters is that the downgrade to build ratio in those structures are actually going down, but it's not so far a disaster, to be honest. Default rates are rising, but so far still moderately. And when you look at Fitch recent statistics, for instance, we have gone from 5.6% of default in all the private credit sphere that they rate to 5.8% in January 26. And most of those new defaults are coming actually from a peak in year of cash interest, which is driving the defaults up. But so far, 5.8%, despite the fact that it's the highest among the history of Fitch, is still pretty limited compared to the recent history. So what it means is that above the risk coming from the fundamental factor so far, the main risk is a liquidity factor, where we could actually see a snowball effect coming from fears rising from retail investors, and then obviously that could potentially create more problems with the funds, as long as when you block potentially the liquidity in the funds, people might wonder if they are as safe as their price look like. So what does it mean in the future? What we'll probably are going to see in the future is more differentiation, I think, among most of the BDC structures. So the BDC structures today, when you look at the main BDC funds, some have a very high leverage. So that's the case, for instance, with the FSK fund coming from KKR, which has a debt to market cap around 2.7 times. Same when you look at the Horizon Techno Finance, which is around 2.4 times. While at the opposite of that, you have some funds with very low leverage, which have maintained a limited leverage. That's again for Main Street Capital, which is one of the best BDCs, the Hercules Cap, the RS Capital 2, which are below 1.3 times of leverage. So number one factor to look at. Second factor to look at, obviously, will be the trend in non-accrual rate and the level of non-accrual weight. In some cases, it's increasing significantly. So that has been the case, for instance, with structures such as FDUS, OCSL, and PSEC, where we have more than 3% of non-accrual. But again, in the flagship structures such as RS Capital, BXSL, or Main, we are still around 1% or very close to 1% of non-accrual, which is not a problem. Third, price to NAV will need to be closely watched out. And fourth, I would say it's the percent of peak in the total income, where we also see some differentiation player per player. When it's reaching 10% or being close to 10%, that potentially is the mark of a problem in the fund, which is, again, not the case for most of the structures there, but it's the case for some of those.
Thank you, Thibault. So, all in all, what comes from this discussion is that for the moment, the global macro cycle is supportive, is resilient, despite many fragilities building within the AI ecosystem. So ultimately, this capital that is being deployed can only be justified if AI delivers real gains to the economy, which brings us to our next topic and our next question on the productivity revolution that is promised by AI. So, Adrien, my question for you, technological revolution often took time to offer productivity gains. Are we too optimistic on AI this time?
Yes, good morning, good afternoon. So I think your question is this time different? The debate between promises and reality. So first things first, let's back to history, I think, and historically AI and related technologies, I think, have shown some impact, some clear impact. And early AI and industrial robots, for example, just have contributed to productivity gains, mostly around 0.6 to 0.8 for early AI and for something close to 0.4 for robots. So that's clear impact, but it was not enough, for example, to reverse the decrease in productivity gains that we have observed over the recent decade. So your question is that Gen AI, is this a new hope, let's say, for a productivity revolution? And I think we can focus on two things: what we know and what we don't know. So first, what we know is very promising results for micro-studies. So early micro-studies show very, very promising results, and I will give you some examples. So for example, regarding customer service, and customer service agents using Gen AI just handle more chats and are much, much more efficient. That's the same for skilled workers, and I would just share experiments within the research with tech analysts, for example, or just economists, and I think we are experiencing very, very strong productivity gains, and let's say faster and stronger analysis within the team. And I think on the micro level, we see very impressive results. At the macro level, on the contrary, it's unclear. That's too soon to say, and let's say we don't know. I think there is still a gap between these small scale successes, let's say, and large scale macro economic impact, and we are very, very careful to distinguish the two impacts. And on macro models, just estimate some productivity gains between 0.1 and 1.2 percentage gain of total productivity factor per year. So that's very, very uncertain. So of course it could be a real revolution, but we have to be very, very careful. And I think it will depend on three things. First, is task automation profitable? And the discussion with you, Eric, was very interesting. Second question, are businesses willing to reorganize? So let's say it's too soon to say, and it will depend on sectors. And the third question is, how quickly will these technologies be adopted?
And for Europe, can it be a sustainable driver of growth?
I think, of course, it's a big opportunity, and I will talk about Europe, but also on France. For example, regarding France ranks fifth largest user of AI globally, and more than 44% of French people are using AI. So that's quite a big numbers. So that shows some very genuine, let's say, enthusiasm for this technology. But regarding companies, adoption within companies is still very, very uneven, and it depends, for example, on size. And big companies are adopting AI very, very fast. It's not yet the case for smaller companies. Of course, it will also depend on the impact on jobs. And let's say, I think it's definitely too soon to say. Some studies suggest some potential relative slowdown in job creation, especially in profession impacted by AI, while on the other end, for example, a recent ECB study shows that companies who have very intensive use of AI are hiring additional employees. So just to mention, the jury is still out, and it's too soon to say. So maybe just to conclude on your question for Europe and for France, I think staying at the forefront of this wave is definitely essential, and significant investments will be key to unlocking these productivity gains and ensuring, of course, that we don't miss out of this technological shift.
Thank you, Adrien. Now, switching to Asia, my question is for you, Trinh. Asia is at the center of the global hardware boom. Can it spill over to the broader economic growth in Asia?
Absolutely. I think the most obvious channel you can see in Asia is through the direct exports channels. A good example is Taiwan GDP. Did you know that was more than 8% in 2025? And more than 50% of that, about 4.5% of that is coming from net exports. So AI is certainly positive for the countries that export hardware. And they are generally the North Asian economies like Taiwan, South Korea, Japan, that builds out the important infrastructure for hardware. So a lot of the CapEx that's happening in the US and across the world requires the hardware coming from Asia. Now, it's not very even in terms of export exposure. At the higher end, as mentioned, we have the North Asians, the Singaporeans, and even Malaysians and Vietnam and Thailand. But at the lower end, it's really India and Indonesia that have very low share of tech exports as a share of GDP. So the positive contribution to growth is much more obvious for some than the other. Now, the next channel of transmission obviously is CapEx, right? Most of the CapEx, of course, is driven by the US, but within Asia, it's the North Asian. Again, it's the Taiwanese, TSMC, it's the Japanese, it's the South Korean CapEx, it's the Chinese CapEx. Now, they're driven primarily by private sector company. But two things to mention, to have a caveat on. Not all of TSMC investment is within Taiwan, for example. A lot of it's deployed in the US and in Japan, for example. Secondly, with this, there's a risk when it comes to this investment pledges, right? South Korea just recently passed the investment pledge, and that means that outward FDI into the US. So just because there's capex by these companies doesn't mean they're going to take place in these countries. Second thing to remember is that Southeast Asia has very low capex from a private sector perspective, but it doesn't mean that there isn't any capex happening in terms of AI. In fact, if you look at a country like Malaysia, which has had the highest net inflows of FDI and capex into AI-related sectors, whether it's semiconductor in the packaging of it or into data centers, which has been receiving a lot, has been a huge driver. So the third is really consumption. So when you think about consumption, how is AI helping with consumption? Obviously, wealth effects is one. So if equity markets go up and it spills over to household and household have a positive wealth effect, then that has a positive impact on consumption. In Asia, Taiwan again shows up because it has very high household ownership of equity, roughly about 25%. And so is Japan and South Korea with less, about 20. But the rest of them have very low. Like on the higher end, you have India and China. But the Southeast Asians' ownership of equity is very low. So given that you have a divergence in export share of GDP, you also have consumption wealth effects less for the other countries. So we think the wealth effect, the consumption effect from this is more limited. The second aspect, of course, is income growth, right? So if you have a lot of jobs in AI, and that can create consumption growth as well. Now, this is where we find it very questionable because in Malaysia, for example, the capex is very capital intensive and it helps with real estate boom. It helps with demand for power and so on and so forth. But it's not very labor intensive. So therefore, headcount demand is not going to be meaningfully increased through this AI. Finally, relating to what Hadrian just said on labor productivity, it's much more iffy, right? On the one hand, adaptation of AI is important. And when you look at studies of countries that are much more prepared by this, like the IMF study, then Singapore goes on top, whereas the other countries are less prepared. And finally, I think there are big risks to countries that export IT services like India, where there's roughly 5.5 million people work in IT services, and that's a large segment of the income tax paying and formal job. Secondly, in the Philippines, we have the BPO sector. If AI is actually as good as it is, and these agents are very good, it means that there's a huge risk to these sectors. And already in the equity market of the India, for example, this huge shaken by this AI and headcount demand in the IT sector of India has been very soft because of worries about this, right? Because, will AI eat software? That's a big question. So we do think the adoption of AI can lead to productivity gains, but when it's adopted too well, it can actually eat up other sectors. And that, therefore, the two most direct channels for Asia, the most important is exports. Not everybody gains. The second one, obviously, is capex in itself. And over the longer run, perhaps labor productivity. But who gains from that remains uncertain. So Singapore certainly is probably better positioned for it.
Thank you, Trinh. So very uncertain macro impact, and what's also even harder to tell is how transformative it will be at the macro level, and it's also true at the corporate level. So this leads us to our next topic on AI leaders and the challenges they will face in this global race. So first, a few words on equity valuation. Of course, this is a strong topic. Tech valuation are, of course, are expensive, and the hype around AI has driven many investment flows. Is it too expensive? I would say three things. First, let's say that the global macro backdrop is providing a strong justification for this high valuation. We have had an extended economic cycle, low real rates, pushing investors to growth assets. And abundant liquidity, also we've seen it on gold, for example. So it's not only a tech story. Tech is not an outlier in this tech expensive valuation theme. Second, tech valuation have been supported by very unusually strong fundamentals. If we decompose returns of the last decade, for the MSCI World at the tech level, it's half of the performance coming from real EPS growth and half from PE expansion, so balanced mixed. And if we look at Magnificent Seven, at these leaders, specifically, real EPS growth has actually been the quasi-exclusive driver of returns. So valuations are expensive, but they are very well supported by fundamentals. And third, I will also say that since the start of the year, we have already seen some normalization in valuations with this so-called AI scare trade. And US techs now appear even cheaper tactically and in relative terms. PE ratio of the US tech sector has dropped from 31 to 23 in a few months or weeks. So the PE ratio of the US tech sector is now close to the one of the Japanese, European, or Chinese tech sectors. So somehow we can say that the US tech valuation has faded geographically. And also within the US markets, within US indices, the derating of techs across sectors has also been seen, and now industrials and consumer discretionary are actually more expensive than techs. So overall, tech is of course expensive, but we cannot talk about a bubble in our view. And we think that the main risk may not come from valuation, but more from a prospect of underperformance in the long run if their ambitious plans fail to materialize. And this leads me to my question for you, Thibault. One of the key concerns is the massive investment program they are displaying. How is it perceived in the credit world?
Absolutely, Emily. So that's the main question. So if you take basically the four big hyperscalers, Meta, Amazon, Google, and Microsoft, and you add to that Oracle, basically if you take the full capex, the picture as of end of 2024 was around $215 billion of capex, which was already a big level. For 2026, the expectation is around $650 billion for those five companies, which means capex will triple in 2 years, and probably slightly higher even in 2027. The problem being that at the moment, despite the fact that the operating cash flows are growing fast, obviously, it's difficult for those companies to monetize fully AI in terms of operating cash flow. So basically, the growth in operating cash flow is not as strong as it is in capex. As a result, what we see is that the free cash flow after dividends and share buybacks used to be for those companies between $70 and $100 billion cumulative for the top five of those companies from 2023 to 2025 annually. In 2026, because of the significant rise in capex, that will probably be negative by around $25 billion, even assuming that there will be a reduction in dividends and probably a redemption in share buybacks for most of the companies. So that means that obviously credit markets are worried about how are they going to finance that growth in the future, and there will be a deterioration in credit quality because of those cash burn. So then there are two things to watch. First of all, the question is how is the supply demand on the credit market reacting to that? Good news is that when you look at the primary markets, Amazon was able to issue recently, as you have probably seen, 14.5 billion euros in 8 tranches on the euro market with almost 28 billion orders, which was one of the biggest order books we have never seen on the euro market. So far, we can't say that there is no more appetite for those tech deals. It's definitely the opposite. Now, on the other hand, what can we say? First of all, it was only 2 times oversubscribed. So it was not a massive oversubscription, which means that Amazon also took profits of the space they had in the market to issue tons of bonds, and they know that they will probably continue to have to issue as the other hyperscalers need to do for 2026 and probably 2027. Second thing, we are starting to see an underperformance on the bond market, secondary market. If you look at the performance of tech in dollar versus the non-financial index, it's roughly between 20 and 30 basis points of underperformance compared to swap since early 25. So definitely, because of that huge level of supply, so far it's almost $100 billion for those companies accumulated that they have issued on a year-to-date basis, which is roughly the amount they issued as a whole for 2025. So it tells you obviously about the huge funding program they need to do, and obviously even though the demand is there, they need to have some adjustment on the market. Having said that, the premium for having those bonds is still limited. When you look at Amazon and Google on the euro-denominated market compared to the rest of their peers or rest of the non-financial universe, it's around 10 to 15 basis points of premium for the same rating, same maturity, which is still pretty limited. But what we are starting to see, particularly on the dollar market, is much more differentiation and steeper credit curves on the long end of those issuers, particularly for between 20 and 30-year bonds. And I suspect that will continue because those companies will need to issue more, will take profits of the markets being opened for long maturities, and investors will continue to get, let's say, more and more worried about the question of future credit quality for those. So we'll see more steepening, I think, on the curve, particularly on the euro market compared to the dollar. Second thing now, it's fundamentally. Fundamentally, should we be worried about the fact that those companies are going to be free cash flow negative in 26? Probably not for the majority of those, because in 2027, if our calculations are correct, the sample of those top 5 will be again free cash flow positive after share buybacks and dividends. So that's basically that's a gap, a funding gap for 2026, which probably not going to be replicated for the next year. So that's a good news. Now, differentiation again will be key. So there will be the players with huge cash at the balance sheets, which is the case for most of those, let's say the top 4 that we mentioned before, but it's not exactly the case, the same situation for Oracle and CoreWeave. There is the question of leverage. Where is the starting leverage as a debt to EBITDA, where we see different profiles there. The question of what is the exposure to circular financing that Eric mentioned before. So in some cases it's very low, in some cases that's not the case, such as Microsoft. And the question of is it a limited or a significant AI disruption risk on their core business models, which is not the case, for instance, for Meta, but is probably more significant for Microsoft, for instance. So if we take all those factors into account, we actually see that with Meta, particularly with Google, and to a lesser extent with Microsoft, there is no big fear to have. On the other hand, companies with high leverage, difficulty actually to finance the huge free cash flow negative that will take place in 2026 and maybe again in 2027, might be a problem for CoreWeave and Oracle to a lesser extent.
Thank you, Thibault. So this is a global race they are running, and this is also probably the reason why such debts are emitted. So a global race, also because of the rising competition, with the margin these techs are displaying, we think there probably some room left, but the question of competition in technological revolution is important. So we have recorded one question to Gary. We all have in mind, Gary, the DeepSeek moment. Is China and Asia a challenger for AI leaders in the long run?
Thank you, Emily. These are very interesting questions for investors into the AI story. Despite the very volatile global environment, it is important to look through the noise and focus on the underlying competitiveness of Asia in the global AI ecosystem. To me, it is about two themes. We need to understand where Asia sits in the global AI supply chain, and it is also about the China-US competition story. And to the first point, much of the Asia demand nowadays is still driven by the massive investment by US hyperscalers. But the hardware backbone enabling this expansion to happen is still very concentrated in Asia. Taiwan has more than 75% of the global foundry businesses. South Korea is very dominated in memory chips. Japan also holds hidden gems in advanced manufacturing, given the very high degree of industrial specialization. So in short, without Asia, the global AI boom cannot really take shape. And regardless of which US firms actually win the AI race, they will still need this component from Asia supply chains in the AI ecosystem. One market that we haven't really talked too much about is China. It is pursuing a very different path, focusing on cost efficiency across the whole AI development cycle. We can think of the AI competitiveness in 4 stages. First, within the data side, China obviously have a very large amount of data in the population and the manufacturing sector, so there's not really a very big problem about that in terms of the size. But the other 2 steps seems to be a bit more challenging. For example, for computing power, China is facing a very big constraint because of the US export control, but it is also trying to bypass this hurdle by developing lower performing chips, but with a bigger quantity and using more electricity, trying to achieve at least a similar outcome. And this has enabled China to change the model, but at a relatively lower pace than the US. But still, we do see the gap narrowing between the 2 countries. For example, the DeepSeek moment is a very clear example that the world kind of changed the narrative on China's innovation, that it can actually develop something from 0 to 1, not only improving existing technology. And lastly, for the 4th part, China has the strongest advantage in application because of the wide adaptation of AI, especially for industrial. So therefore, the bottom line of the whole AI story in Asia is that it will probably not be able to really challenge the US in the AI platform dominance, given the massive investment. However, most of the market in Asia is very important within the AI ecosystem. But one outliner is that China is likely to have the greatest potential to emerge as a challenger to the US, given the more well-built ecosystem along all the stages.
Thank you very much. And another competition our AI leaders are running is a competition, I might say, between versus the real world. And this leads us to our 4th and last topic on the structural limits for AI to grow further. So Ivan, energy demand from data center is rising extremely rapidly. Could energy become a bottleneck for the development of AI?
Thank you, Emily, and good day to all. So indeed, electricity supply is a key topic for data centers and in turn for AI. Probably as an introduction, you all know that data centers are a very energy or electricity intensive type of infrastructure, and development of AI entails development of even more electricity intensive data centers, which are running fast servers. So clearly what we expect going forward is the electricity intensivity of the sector to increase over the years. And as a result of this high electricity content of data centers and AI, what we see for data centers currently being operated is that they heavily rely on electricity for their OPEX, and electricity generally represents something like 20-30% of the OPEX base. Now, taking the macro side, it's still difficult to determine at this stage how much electricity will be needed in the next few years to power AI. Why? Probably for one reason Adrien alluded to earlier, is simply that we don't know exactly the pace and magnitude of AI adoption going forward. So we can probably stick to a sort of baseline scenario the IEA came up with recently, which actually banks on electricity related or AI related electricity consumption growing twofold by 2030 and representing something like 900 terawatt hours, which is roughly the equivalent of Japan's annual electricity consumption. So in relative terms, it means that AI-related electricity consumption would represent something like 3% of the world's electricity consumption, up from slightly below 2% today. And probably more interestingly, if we look at the incremental electricity consumption by 2030, AI would only represent 8% of this total, lagging behind other sectors like transport and industry. So all in all, at the macro level, what we see is that AI contributes significantly, but not overwhelmingly, to electricity consumption growth. And so for the big picture, it is manageable. Now, looking at the micro picture, things are probably different and a bit more challenging. Why? Because challenges surrounding electricity supply for data centers are mostly locational. And the reason for this is that data centers are traditionally concentrated in specific areas close to telecommunication access and urban centers. So here are the two main challenges in relation to electricity supply for data centers come into play. The very first one is that data centers have very specific needs in terms of electricity supply. In particular, for data centers, electricity has to be available 24 hours a day in a baseload fashion. It has to be competitive because of the share electricity plays in the overall OPEX space. It has to be at scale, and that's something very important given the growth in size for data centers. And finally, to the best possible extent, it has to be low carbon to overcome some potential social opposition. On top of that, when electricity is available, data centers have to be connected to the grid. And grid connection, in countries like France can take up to 7 years. So all in all, what we see is that these challenges make timely access to electricity a key differentiating factor in the global race to AI development. And to tackle this challenge, we see various electricity sourcing strategies presently emerging. The very first one, most of you know quite well, is bilateral contracting of generation sources directly connected to data centers through PPAs, power purchase agreements. The number two strategy, which is emerging, is vertical integration with hyperscalers buying suppliers of electricity, as we saw, for instance, recently with Google acquiring Intersect for a cash consideration of slightly less than $5 billion late last year. The third option presently emerging, which is very interesting from the perspective of the transitioning of the old energy system, is the repurposing of existing sites which have land and grid connection, which is typically the case of coal-fired plants, which in addition to land and grid connection also have some access to cool water because of the cooling needs of coal-fired plants. And finally, something which is probably more forward-looking is the conclusions of strategic agreements between hyperscalers and providers and developers of new nuclear technologies like SMRs, small modular reactors, to deploy generation facilities on site. So all in all, what we see is that electricity supply is becoming increasingly strategic for AI players. It's not so much the question of how much, it's probably more the question of when, because of this time to market, dimension of electricity sourcing, but also how. And that's probably the point I want to conclude on, because we've touched upon electricity sourcing, not specifying what type of generation assets will be deployed to meet incremental electricity demand. Obviously, there is a consensus that growing share of renewable energies in electricity systems will make the lion's share of electricity sourcing. That's true, but electricity generation, renewable energy sources have now to be complemented by storage devices like battery storage systems to actually accompany the needs of data centers operators. And probably in the short term, what we should see before SMR solutions are practically activated, not probably before the start of the next decade, we should see a surge in the use of gas and coal-fired plants in lots of countries. For gas, could be US and Germany. For coal, it could be China and India, to actually satisfy incremental demand from AI developers, and also to bridge the gap between renewable energy sources, which are low carbon but intermittent, and SMRs, which are also low carbon but provide baseload electricity sourcing. That's it on my side.
Thank you, Ivan. Eric, how fast can improvements in computing efficiency offset this exploding demand?
Well, I think it's what Ivan said is interesting, because we're going to have to think about making some climate targets arbitrages here, like using gas, using all sorts of fossil fuel, sources, if we really want to supply the industry properly. There's another way, of course, which is, can we make AI more energy efficient, more frugal, and there's really three ways of looking at this. First, at the data center level, there are many ways, many options for them to actually consume less energy. I can give you an example, which I think is quite interesting. Cooling typically represents 30 to 40% of the energy consumed by a data center. People talking about liquid cooling instead, immersion cooling. All of these technologies are, of course, a lot more efficient, but they have trade-offs in terms of water usage, in terms of architectural design for the data center. What if, instead of doing that, we let temperature rise in those data centers and we use less cooling? For every degree Celsius of temperature, extra temperature in the data center, you get 4% savings on your energy bill. It's massive. The only reason we're not doing it is because the end clients don't want to take the risk of damaging their very expensive GPUs from NVIDIA. But we need to look into whether these microchips can take it. Then there's efficiency that can be gained at the hardware level, at the microchip level. There's a lot of research going in that sector, in the memory segment, high bandwidth memory. As you know, I've spent a lot of time working on those little components. They are essential to reducing, the heat that is actually generated by the movement of, electrons of data between core, compute, and memory. Same thing, if you start using SSD drive instead of hard drive, you're going to save a lot on your storage energy. And then at the, again, in the inference era, I think we're going to see the emergence of very specialized chips that are going to be orders of magnitude more efficient than the ones that we're using today. So TPUs from Google. You saw perhaps that Amazon basically signed a very interesting deal with Cerebras last week for some special microchips for inference era. So again, that will be a way to improve on the efficiency. And then the last point, of course, is on the algorithmic level. We saw with DeepSeek that just by optimizing the algorithm, you can actually make things a lot more efficient. And I think that's only a beginning here. We're gonna see a lot more of that going forward.
So is the bottleneck coming more from components, from semiconductors?
At the moment, yes, that's a serious problem. There's a real risk that component supply will be insufficient to meet the demand in the coming months and years. Again, at three levels. In cutting-edge logic, we've heard the CEO of TSMC acknowledge recently that his platform is basically 3 times short, of the demand from its main customers. Okay, and that's coming from by far the biggest manufacturer of semiconductor microchips in the world. In the memory space, we've already seen that DRAM prices have increased basically 50 to 60% this quarter. HBM memories are sold out to 2027, and what this means is that while the big hyperscalers will probably still be able to secure their deliveries because they are big, because they've got scale, they've got the firepower, all the other smaller manufacturers will struggle, I think, to operate normally. Look at the price of a normal laptop or an iPhone. All that is going to increase significantly because of these component shortages. And then even if you have your memory, even if you have your compute, you need to be able to assemble that in a workable package. And advanced packaging is also sold out to 2027 at the moment. It's a sector of the supply chain that has been totally underinvested over the past few years. And so we are going to see bottlenecks as well coming from there. Those bottlenecks we know come from insufficient capex from maybe 3-4 years ago, just after COVID, companies like TSMC's did not invest immediately in the AI wave. And that's probably what we're seeing today as a result is insufficient capacity. Now they're saying that they are going to increase capex by 30-40% this year. That's a huge increase. But keep in mind that none of that will come online until 2028 in the best case scenario. So these imbalances are going to continue. It's going to be even worse, in fact, because competitors like Intel, Samsung are far behind TSMC's and they are unable to plug the gap at the moment.
And it was already tense supply chains before the current crisis we are facing in the energy and geopolitical space. So what are the risks now?
So you mean with the
Iran
situation? Well, certainly it's not helping. The semiconductor industry relies heavily on a number of raw materials to fabricate microchips. I think one of the examples that is often cited is helium. It's a raw material that is used for thermal management of semiconductor wafers or for clean room lithographic processes. So it's really a key product. I think the semiconductor industry uses about 20% of the world's supply of helium. So it's not insignificant. A country like Qatar is producing 38% of the world helium. And of course, people like TSMC and Samsung are big importers of the product. So yes, long disruption in the Gulf could potentially become problematic from that perspective. Helium is not, by the way, the only product. There are other things. Like bromine is also used in etching and flame retardant compounds, so that your batteries don't catch fire in all sorts of applications. I think our colleague Bernard Dada wrote about sulfuric acid recently, and it's true that it's used in the extraction and refining of a number of metals, rare earth elements that are critical to the supply chain, of course. So, long conflict would obviously be a problem. That said, supply chains are relatively resilient. It's not the first time that we have disruption out of this region. They have diversified already from producers in the Gulf. Prices will likely be under pressure or positive pressure, I would say. But from pure shortage disruption point of view, I think it's going to take some time before we see problems.
Okay, thank you, Eric. So my last question for you, Rita. Regulation is also becoming an important question and maybe an important limit on AI development. Could it slow down this development?
Hello, Emily, and thank you. Hello, everyone, and thank you, Emily, for the question. And I mean, you're right. Regulation is one of the most debated questions around AI right now, and it's because while AI is growing more and more powerful and more widespread, we're seeing more real-world risks and concerns, from the deepfakes incidents recently to fraud, to cybersecurity and data privacy concerns. And so regulation is absolutely necessary, but will it slow down innovation? Well, to answer that question, I would have to look at the three main approaches globally adopted today. On one hand, we have the US with a very light touch pro-growth approach under President Donald Trump, and his focus is very clearly on removing barriers to AI development and preserving this American leadership. And this strategy has worked quite well, and we can see that it has helped create a very innovation-friendly environment for AI companies in the US. Now, on the other end, we have Europe with a much stricter regulation that follows a precautionary, more risk-based approach, which requires a lot more documentation and places stricter obligation on higher risk application. Now, what this approach has done is it has raised the barrier to entry and the cost of compliance to European players, and it has slowed down deployment, especially for smaller firms. But Europe, not only that, but it also suffers from heavy administrative inertia. So state support for AI companies moves too slowly, and many firms need large amounts of capital quite quickly, and they simply cannot afford to wait these months to secure it. Now, Europe needs to learn to channel its support more efficiently for AI innovation to flourish. This brings me to the third approach, which sits somewhat in between the two models I previously discussed, which is China. And what's really interesting with China is that despite its very demanding requirements, from very strict filing mechanisms to strong content control, it has remained a leader in AI development, and we saw that with Chinese models coming out like DeepSeek and Kimi K2 that were quite big. And this is because China combines this strict regulation with subsidies and infrastructure support that reduces compute costs and capital costs for AI companies. And so regulation alongside very strong state support is what is allowing Chinese firms to scale rapidly. So to conclude and to answer your question, regulation is not what stifles innovation, but innovation is stifled when regulation is heavy and when support is weak. And what matters a lot is how regulation in these countries is being designed and whether it's matched by funding, infrastructure, and policy support. And it's the way you channel that support towards the end users and innovators in the ecosystem that would really help create a more sustainable ecosystem for the industry. Thank you.
Thank you very much, Rita. Thank you all. Thanks for attending also. We are perfectly on time. So Eric was our Q&A watcher. So do you see some question or do you have some concluding remarks to this webinar?
Yeah, there were a few questions, but I believe we've actually answered most of them during the session. So perhaps some concluding remarks. And first things first, I think AI bubble, I think you were right. We need to get rid of that appellation. There is no such thing as an AI bubble. I believe, we talk about bubble when valuation diverge from fundamentals. And like you said, the fundamentals are still strong. There is EPS growth. The AI story is absolutely real. We are going into the age of agentic AI, and this is going to be really impressive. And it brings tremendous opportunities for everyone in the US, in Europe, in Asia, as we've seen with our colleagues there. What we do have, however, is a number of potential risks emerging. I mean, Thibaut, you showed us that the credit situation, if it's still sort of under control, needs to be monitored closely. It could potentially become problematic at some point. Energy risks with Iran, of course, could become a problem in terms of time to market, in terms of efficiency, in terms of climate arbitrage that might have to do to supply the AI world properly. In terms of supply chain, we just addressed semiconductor supply, geopolitical and so on. So, and potentially with Rita, regulation also could become, a headwind. But, so far so good, I would say. And certainly this remains a tremendous driver of growth, in my opinion, for the coming decades. Perhaps I would like to leave the audience with one thought, just to scare everyone. What if actually, markets have been doing this completely wrong from the start? What if we've actually invested hundreds of billions of dollars in a technology that will become obsolete within 2 to 3 years? We're talking about transformer models right now, but they are very limited. They continue to hallucinate. scientists like Yann Lequin is now raising $1 billion to actually start working on his own startup world model, which I understand will be a type of model that will learn about the world the same way that human beings are learning about the world. And if he manages to do that, then do we actually need all these data centers? Do we actually need to spend hundreds of billions on GPUs to power the next generation of models? The debate is, of course, open. I don't think there is imminent disruption, but when we start financing, all these data centers and infrastructure, we need to keep that on the back of our mind, I suppose.
Thank you very much, Eric. Thanks, everyone, for your attention. And interesting development for sure going forward.